Welcome to the Trust Us, We're Professionals podcast with your friends from SSC, CPAs, and advisors. This is the podcast where we break down financial matters found in pop culture, the ether, just, the national conversation. Basically, we try to make complicated financial matters easier for the average Joe to understand. We're all licensed financial professionals. I'm your host, Chris Underwood, a licensed financial advisor with SSC Wealth, and I'm happy to be joined once again by Michelle Hammond and Chris Cohart. And before we begin, did you guys actually do your homework and watch the movie this time?
Yes, I did. Multiple times this time, actually.
Yeah, I did. I watched it because it's been a long time. I fell asleep, and then I started it again. So I watched the whole thing through osmosis once, and then the whole thing in real time again.
Okay, so we're very well prepared.
So prepared.
Awesome.
And I lived this. Like, this is like a whole flashback preparation episode.
Yeah. So did you say that you fell asleep to it because you had watched it before?
No, I was just tired.
Yeah, or older.
Yeah, I'm 42 almost.
It got to 9 o'clock, and we were both like, oh, gosh.
Out.
At 9 o'clock, accountants must go to bed. It's a rule. For today's episode, our sixth or fifth, I'm losing track, who cares? Our topic is definitely the most accounting-y? That's a made-up word. It's the most accounting-based pop culture topic in our short podcast history. Today, we're going to be talking about the infamous accounting at Enron and the Oscar-nominated documentary, The Smartest Guys in the Room. That was the movie we were referencing. Now, I would imagine the general population did not make a beeline to the movie theaters to see this movie when it came out, but I would also bet the majority of people have heard of Enron. There's a lot to the Enron scandal, and it would probably take 4,000 podcast episodes to get through all the details, but we really don't want to put our audience to sleep, so we'll keep the discussion as short as possible by defining the type of fraud they perpetrated, identify the three elements of the fraud triangle. Don't worry, I'm not sure what that is, but I'm pretty sure Michelle and Chris Cohart will tell us what the fraud triangle is, and finally, briefly discuss how they perpetrated the fraud. All right, genius accountants, Enron, biggest accounting scandal of all time, one of them at least. Have at it.
Absolutely. Yeah, I think Enron happened during a period of time that, I think, what would we call it? The golden age of corporate fraud. But
kind of puts a positive spin on it, though, Cohart.
It does. It's not really
I miss those days.
Oh, the good old days. Back when you could get away with
Right. This was in that golden age, as we're calling it. What can we say? Black age? Dark age?
the dark period.
Dark period.
Mm-hmm.
Yeah, the dark period of corporate fraud, 1998, 2008. And when I was kind of researching that period of time, and I think I counted 29 different corporate frauds in a span of 10 years. That's a huge number of corporate frauds and big corporate frauds, and by far the most that I counted in any 10-year period. And heck, I think there was more than the next 10 years combined.
And we picked Enron out of the golden age of corporate fraud because, well, one, it has a movie about it, and two, it is considered one of the largest, if not the largest, documented fraud. So for those of you that have not seen it, great movie, Oscar nominated. Here is a quick synopsis from IMDb about the Oscar-nominated documentary, The Smartest Guys in the Room. Based on the best-selling book of the same name by Fortune reporters Bethany McLean and Peter Elkind, I'm not sure if I'm pronouncing that correctly. This is a multidimensional study of one of the biggest business scandals in American history. The Chronicle takes a look at one of the greatest corporate disasters in history, in which top executives from the seventh largest company in the United States walked away with over $1 billion, leaving investors and employees with nothing. The film features insider accounts and rare corporate audio and videotapes that reveal colossal personal excesses of the Enron hierarchy and the utter moral vacuum that posed as corporate philosophy. The human drama that unfolds within Enron's walls resembles a Greek tragedy, it does, and produces a domino effect that could shape the face of our economy and ethical code for years to come.
And I think it did. I think post-Enron, they had a law created after it. They weren't named after Enron, but there was absolutely a kind of a law governing corporate accounting and corporate culture a little bit. And that was the Sarbanes-Oxley Act. I never lived that. I got kind of by side angles of that where when it was implemented, a lot of the not-for-profit audits we were doing, a small accounting, they were referencing Sarbanes-Oxley, but they didn't really it wasn't really relevant to them. But I know Michelle lived that life because she was at PricewaterhouseCoopers right at that time. I think you just graduated.
I did. So I did my internship in 99. So it's like pre-post Enron. So during my internship in 99, we learned one way to do auditing and one way to think about things. And then I come back and I start in public accounting on September 11th, 2001. We can break that down some other day. That was the glorious, illustrious start of my public accounting career. And we learned a whole different way to look at an audit and what publicly traded companies were required to do, all because of many of the things that happened at Enron and the 29 other global corporate frauds. And even from that, after Sarbanes-Oxley, they've come up with new ways and new rules that govern how you do accounting for different entities that you own and the way that you do other valuation of investments. So this just didn't result in one act. This changed how financial reporting and internal controls were done for all publicly traded corporations in one fell swoop. And then it slowly trickled down, and now it's for small businesses and not-for-profits.
So, okay, Enron created this massive domino effect, changed everything, changed a lot of stuff. Let's tell the people, what type of fraud did Enron perpetrate? I can't talk. Speech impediment when I was a kid. That's true.
Well, that's a good question. And I think generally speaking, what do we see? There's two major types, really two types of fraud.
Right.
There's two types of fraud. There's misappropriation of assets.
Easy for you to say.
Yeah, and financial reporting fraud. Those are the two major. That's really the two that we have. And misappropriation of assets being, I guess I would consider that probably the most common, but it's probably not something that is as public as the financial reporting fraud.
This is what happens to our small business owners every day, or even like PTOs where they find out that the treasurer stole all the money from the PTO's bank account because she was writing checks to herself. I mean, that's misappropriation of the assets of the PTO, right? They took that money. Where inventory is stolen, where cars magically fall off of dealerships' books. Those are it's kind of the most basic or more prevalent, let's go with prevalent type of fraud that happens is the misappropriation of company assets.
Yeah, and I think it can happen at a lot of different levels. And misappropriation of assets is kind of a hard concept to really think at. It's really kind of a theft of assets in a lot of ways. And the assets being cash. You know, the theft of cash can come a lot of different ways. Straight taking cash. You know, not everybody, a lot of businesses have that petty cash fund. And so you just pop in and grab a few $100 out of the petty cash fund. It can also be by shorting your deposits, those bank deposits. I took all my deposits and, there's that little spot where cash back, let's put $100 cash back on there, $1,000 of cash back. I think some of that, we've made a lot of strides of kind of making that a little bit more difficult, where we're doing a lot more digital deposits, scanning checks, doing that in a digital way. It makes it a little bit harder, but there's still plenty of ways to steal cash.
People misusing their company credit cards. I think they had the case where a Nike executive here recently, her kid took her credit card and bought a bunch of high-end Nike shoes and then was reselling them on the internet, making good money, all just on the Nike corporate credit card, buying Nikes at least. So that was a nice touch, and that fraud can come in a whole bunch of different ways for small business owners. And what Sarbanes-Oxley did to try to address those things is to help people develop a framework to put the controls in place to make it so that a person can't use a company credit card to buy something that's not allowed, and putting in those approvals, putting in preventive controls to make sure that they can't use the credit card in the wrong way, and then also to put in detective controls to make sure that if they did use the credit card the wrong way, that the small business owner or the business owner would find out pretty quickly.
So I'm seeing examples here on our outline, and I see larceny, parentheses, office supplies. Am I in trouble because I jacked all those pins?
If you jacked a whole bunch of pins, if everybody in the whole place was jacking pins, I got a problem. Those ones with our logo, those are $1.75.
Are they really?
Yes.
Then I owe you $42.
Yeah, I think that in general, that is a misappropriation of assets. If you just go take a ream of paper from your firm, your company, you're taking business assets for personal use, and that is theft. It's a small amount, and I think a lot of businesses kind of know that that's happening, and it's within a reasonable standard deviation of acceptance. But I think that's usage of taking, like Michelle said, I'm just going to take that car off the car dealership lot.
And it happened at Enron. Okay, they had misappropriation of company assets. The two guys at Valhalla, they were stealing and using and paying for things out of their own money all the time. That was their favorite thing to do. The auditors said, "Oh my God, they're paying for their house. They just bought a boat." Well, you can't. That's misappropriation of company funds, and at its purest.
Well, I think there was also some of what Michelle was talking about, using the corporate credit card. I think that's an easy example, but there's also a lot more of that cash disbursement stuff, like creating fraudulent employees, and we call that the fictitious employees, and paying them, giving raises when a raise wasn't approved, paying yourself more hours. We've seen that a lot. Creating a new vendor for construction that you're doing, or supplies that you might have bought, that it's just running through the process. So there's a lot of other things that just happen with stealing cash that's pretty creative. And if you don't have, like Michelle said, the right approval, the right processes and detections in place, it makes it a lot easier for people to just kind of make way with some of the cash that's on hand. And it's not just cash, but like you said, stealing of pencils too is prevalent.
So misappropriation of assets is basically just stealing from the company in one way or the other.
Yeah, it's more an internal fraud. It's internal fraud. I mean, that not indirectly, it definitely affects the investors. Whether it's a small business that's a single investor that's just one owner, or the husband, wife that's an owner, it's affecting their bottom line and their ability to make a living. But in a publicly traded company, it's the same thing. That stock price and what you're buying and selling that stock for is based off of the profitability of that organization. So internal fraud does have it is just affecting the corporation, but it does affect those investors, those outside investors that have an interest in that organization.
Yeah, those of you that have never paid for a staple in your life, think about the shareholders. You guys said there's two main types. We covered misappropriation of assets. What's the other one?
Fraudulent financial reporting.
Which is not the most exciting one.
Oh,
it's a lot harder to
everyone
explain.
Stop. Let's pause the podcast. Go get your popcorn.
Yeah. This is the one that's harder to explain because you don't necessarily see it like a
Right.
car falling off a car lot, right? So fraudulent financial reporting is cooking the books. You're having a second set of books. And so this is the act of having your underlying books and records misstated. Making your revenue too high, making your expenses too low, taking your assets and writing them up to a really high value when they're not worth that. And then you take that set of financial statements and you go to a bank and you get a loan with no intention to ever pay a bank back. Or you take those financial statements and you walk to your neighbors and say, "I've got a hot deal for you. Look how well this company is doing. Can you give me some money and I'll give you a 1% interest in my hot company?" So fraudulent financial reporting is building financial statements for the end user to rely upon to make a financial decision, and doing it outside of the rules of accounting.
And this is what Enron was doing in spades.
Yeah.
Spades.
Yeah. And I think this is what gets the most publicity for sure. I mean, there's definitely some publicity about misappropriation of assets and stealing from the company, but this is where I would say the largest frauds occur, because they're just huge numbers, and they're usually what we hear about is the Enrons of the world, the WorldComs of the world, that they're just making up numbers to make sure that their stock price and their investors, the cash is still coming in for them to continue to do what they've been doing. So it's definitely the largest, I would say, frauds that occur are financial.
Okay, so Enron was mainly financial reporting fraud. They were cooking the books to get loans to, inflate the price of their stock. Was there any misappropriation of assets?
Absolutely. Yeah. Like Michelle said, the Valhalla incident, which actually was well before the main fraud that occurred, but that fraud absolutely was more misappropriation of assets. And I'd say the documented stuff of the main fraud was more financial reporting, but the way that corporate culture was during that time period, I can't imagine that there wasn't a significant amount of internal fraud that did occur where they were taking extravagant trips, going to clubs and restaurants on the company's dime. I mean, having massive parties. I think all of that was occurring. But I think the bigger aspect, it was overshadowed by the just sheer impact of the financial statement fraud that they were perpetrating and the complexity of that financial statement fraud that they occurred and the amount of loss for the shareholders, the amount of loss for the direct loss for the employees that occurred because of that fraud that unraveled.
Yeah, I would say it was a combo. It
Yeah.
was a smorgasbord of,
Right.
of fraud that happened. And so, for example, when we mentioned the Valhalla, that's a town in New York where they had the two traders who were doing all their energy trading, and these guys were just throwing up these awesome numbers. Like, while everybody else is losing money on energy, they're making money and they're doing great. And I'm pretty sure they have to show that to cover their misappropriation of assets because they were using it for their extra entities where they were buying their boats and cars. This is one of my favorite parts of the whole movie is when they put this together. One of the entities that those guys had was Mr. M. Yass. Okay, he was the owner of one of these entities that they had falsified. Well, it's not Mr. M. Ass, it's my ass. That was one of their clever ways of coming up with covering all of their misappropriation of funds through these fake companies.
And you're thumbing their nose at it too. If you're naming it that.
Thumbing their nose at it. Yeah,
It's
like
so ridiculous.
Catch me, auditors.
Yeah.
Catch me if you can.
I dare you. I dare you.
Yeah, my ass. So, that I think that many times fraudulent financial reporting is to cover up the misappropriation of assets. And it's true because a lot of times inappropriate financial reporting is so that people can get their bonuses.
Oh, absolutely.
And so they jack up their earnings per share. They jack up their revenue. They make it look better than they do. And this isn't just at the big companies. This is at the small companies too. When you have a sales guy who gets a really big bonus for selling through 1 million. And if he's at 995 at the end of the quarter, he's going to find somebody to stuff $5,000 to, or make it look like he sold $5,000, right? Mm-hmm. So, it's not just true at Enron. It's just bigger.
And it's interesting now that I think about this. My brother, I have 3 brothers, but one of my older brothers worked at Enron for a bit, right out of college though. So, I mean, it was like his first year, something like that, when everything happened. But he saw kind of the misappropriation of assets that you were talking about. He told me a story, and this was his, because he was just starting out, so it's not like he was high up or anything. But every single night they would order, bring in food for the whole floor. And the managers, the superiors or whatever would purposely order more food just to get more points on their credit card, like knowing it was going to be wasted every single night. Yeah, he actually, sadly, because what happened was horrible at Enron, but he actually kept his job for about a year after, they went belly up just because he was brand new and there were still some loose ends to tie up, and he just started, so he had a real low salary. So it just shows you, like the people that had been there for years got royally screwed.
Mm-hmm.
And I think maybe the saddest piece of that is all those individuals that are working for these big corporations or small corporations where fraud does occur, they're acting in good faith and working in good faith and really investing their time and in Enron's case, their money. Most of these individuals' retirement was invested in Enron stock. And some of the skeeziest pieces of the Enron is they were encouraging really pushing and encouraging these employees to stick 100% of their retirement dollars in Enron stock. And you want to back a good horse, and they were an innovative company. They definitely represented themselves as an innovative company, but pushing to have that money, that hard-earned money, all go right back into the company was kind of hard to watch, hard to stomach for sure. And I think you could argue that some might contend, well, how is it not internal when they're stealing from their employees? But and they sold all their stock for, what'd you say, $1 billion before this all ended. They weren't taking that money, that $1 billion from the company. They were taking it from really their employees and other outside investors, because they sold all their stock before everything went down to zero. And that's how they pocketed, or they left 2 years before the scandal happened, because they knew they had already hit the number that they were happy with from a retirement perspective. Like, yeah, the stock value is now $90 a share. If I sell my 100 million shares, I'm good. And I'm out of here on this one.
It's horrible. What happened was just horrible. Okay, so now that we know the type of fraud, we've discussed that. Let's talk about the elements of this fraud triangle. Ooh.
Very similar to Bermuda Triangle.
I was
You
about to
go
say,
in,
it sounds mysterious.
you don't come back out.
Yes, once you enter the fraud triangle, you never escape. Right. So I've never heard of a fraud triangle. I'm just like you listeners at home. I have no idea what this is. Chris, Michelle, Shelley.
Again, that's not going
Stop
to
calling
float.
you Shelley.
PJ, cut anytime he calls me Shelley.
My days are limited. All right, explain this fraud triangle, please.
Well, this will definitely, the word you used earlier, what, accounting?
Accounting.
Yeah, this is definitely accounting E. And it's pretty, I wouldn't say it's tough to comprehend it, but we get in a little bit of the weeds here. So kind of the three generally accepted elements that are part of the fraud triangle, thus the triangle, the three sides of a triangle, being opportunity, rationalization, and pressure or motivation, kind of interchangeable. Now, some people have kind of tried to introduce a new element, which doesn't make it a triangle anymore. I think they call it a diamond after that. Then they try to introduce capability. But a lot of times people would argue that capability is embedded in the existing three elements. There's no real need to pull that out and make it its own element. So the three elements of fraud triangle being opportunity, rationalization, and pressure or motivation, whichever term you prefer.
So I mean, you say that's accounting, and I hear that is touchy-feely at its core, right? So we're talking, and we're talking like, what kind of things have to be going on in an organization that make people think that they can do this, that it's okay to do this? How do they sleep at night? They sleep fine because there's an opportunity. They look around, and tone at the top is everybody else is doing it. There's no controls. You do what you want. We'll do what I want. You get ahead. They see other people get away with it, and then they think they can do it. The tone at the top provides for an opportunity where people feel okay with doing something, and then they rationalize it. They weren't paying me enough anyway. I earned, or I deserve this, or I will pay it back, or they didn't need it anyway, or they feel pressure to get that bonus, pressure to make those numbers, pressure for their whole department. And sometimes it's pressures they created on themselves by buying that fancy car or the big boat or the oversized house. I mean, you want nice things, but you have to be able to pay for them, Underwood. I don't know.
I've never felt any pressure to perform. I'm confident in my abilities.
You know what? No truer words have ever been spoken.
I think that tone at the top, what you were talking about, Chris, about your brother, what that tone was, that at every night, his managers were buying excess food every night. And so that is the tone that his managers are setting for him. And so when he moves up in the organization, obviously, unfortunately, Enron ended why he started, but that's an accepted culture for him. The next time he goes out and takes a client out for dinner, it's excess. It doesn't matter. I'm gaining points. No big deal. I deserve it because I'm making this money, So I'm working these hours, so I deserve to get this extra meal or take this extra.
He still can't go out to dinner today without ordering 17 meals. It's just, I mean, see, this is why you need good leadership in front of you. They may leave their mark. It makes a difference.
Mm-hmm.
And you're right, Michelle. This is a little bit of touchy-feely. And accountants, generally speaking, I would say we're not as touchy-feely. There's a handful of Michelles out there that can do both, that are really technical and
very touchy.
I would probably go back to the empathy, empathetic.
Yes.
That's to me, I scored what was the lowest possible on empathy when we did our personality.
Finders?
Yeah.
On Strength Finders.
Right.
There's 34.
I got 34 out of 30.
34 out of 34. That was your last strength. They couldn't find it. They sent me a magnifying glass to find your empathy.
But these are the things that we as auditors have to kind of take into account, and that's not an accounting thing that we can check a box and say, well, that number looks like it has a right tone at the top to be. So you kind of have to be able to, what do they always tell us when we came out? You have to learn how to read the body language, to read a piece of paper upside down, to kind of read between the lines of what that CFO or that CEO is trying to tell you.
And that's immediately what they did at PwC with our training when we first came out. When I started, there was no assessment as it relates to tone at the top, the control environment in which the company's working in. It was, does the thing tie to the stuff, and you move on. Through Sarbanes-Oxley, it came to conversations about tone at the top and how you talk to your clients about fraud. And they actually had a former FBI agent come in and work with us about how to tell if people are lying and what kinds of things to look for as it relates into body language and the documents they give you and the way they interact with you, to try to get a feel if somebody was telling you the truth or not. They did clearly say, don't jump up and yell, liar, liar, pants on fire, but things for you to bring, to your supervisor through the end of this life lessons. And it was not what we were talking about when I was there in 1999.
Right. And I think it's important to note that really all three of these elements have to be present in order for the fraud to really occur, because people may feel pressure, but if the internal controls and the tone at the top is correct, the opportunity to commit this fraud is very much mitigated.
That's a very good point, because I think a lot of people would argue, especially in like sales type roles, motivation to perform is in business, is in line of work. Right. But that's just one of the three. We have opportunity, rationalization, and pressure, motivation to perform. Okay, so we now know the type of fraud, and you guys have all learned about the fraud triangle. Yeah. So we know this, we know what happened as far as the fraud, but how in practical terms did they pull this off?
Fraud rule I want to incorporate is throw out there that really makes me excited is the 80-10 rule from the National Association of State Auditors.
I'm sorry, giddy state auditors and rule. Like it's not normal. You're not normal.
It's not normal.
It's not normal.
But I do have a smile on my face, and I could feel the excitement building.
Mm-hmm.
It looks like Christmas Eve right now.
It does. So, Chris, please tell us about a rule that keeps you happy.
Okay. So the 80-10-10 rule states that 10% of the population will never commit fraud. I like that.
And there's 4 people in this room. PJ.
80% of the population might commit fraud given the right combination of opportunity, rationalization, and pressure.
80%?
80%. Might. So they're not definitely, because all three of those things have to exist, but 80% are kind of on the fence of kind of thinking about it. I feel really unvalued here. I work a lot of hours, whatever the case might be. They're thinking about it and waiting for that potential opportunity. And then 10% of the population are actively looking at systems and trying to find ways to commit fraud.
That's kind of scary. Like really at its core, 80% might. And I guess, no, I'm not going to rationalize this. That's a problem. I was like, well, let's define fraud. Is this where I don't pay use tax on my Amazon purchase? Because that's not fair. That's not fraud. That's a stupid rule. That I follow as a CPA.
Yes.
But that's terrible. Whatever it is.
Yeah, I mean, I'm excited about it. Maybe it's just because of it defines some of this touchy feely stuff that we talked about into numbers. Like, this is what I got to look for. But yeah, then essentially 90% of the population are ready to commit fraud of some type, open to it, whether it's misappropriation of assets or the fraudulent financial reporting.
Or buying a computer, using it all semester, hitting it with a hammer, and then returning it.
Oh, underway.
Okay, so we now know what the fraud triangle is: opportunity, rationalization, and pressure and motivation. Can we talk about those at Enron?
I'm ready. We've defined everything, so now I feel like we can talk about it.
Chris is giddy again.
There's no rules in here, but I guess we'll figure it out. Okay, opportunity. So tone at the top.
Definitely tone at the top.
We talked about Valhalla.
Yeah, and I think what the most interesting piece of Valhalla in that was that the CEO, Kenneth Lay, was presented with this information after internal auditors had found that these individuals were doing misappropriation of assets. And he said, yeah, I see that, but it's the only arm of Enron that's actually profitable, so I can't shut it down. You guys just go do what you do, keep making us millions. And I think there was a memo that he actually said, keep making us millions. And so he encouraged them to keep taking risks, keep doing what they're doing, because it was probably within his standard deviation of acceptance of them stealing from the corporation.
Cost of doing business, cohort. Cost of doing business.
Right.
And the auditors, like, I can't believe, like, Arthur Anderson kept being their auditor.
Because they're getting paid a lot.
There is a piece of that. And specifically in the documentary, in the movie, they speak to that there are checks and balances that are supposed to happen. The auditors are supposed to catch it, the bankers, the attorneys, all of these people are supposed to be somewhat watchdogs of these organizations. But they were all getting paid a lot. And they all had a seat at the table of, would we say, the 7th largest corporation in the world at that point in time. And to turn your back on, for Arthur Anderson, $100 million, what was it, probably
ridiculous.
$100 million.
Consulting fees were more than the audit fees. So is that 80% rule? Probably. Yeah. Absolutely. Right. Okay, rationalization at Enron.
I think this one is harder. I think it's harder because I don't think that Kenneth Lay or Jeff Skilling being, was he the COO or CFO? COO. See, he was the COO at that time.
Okay.
I don't think they set out to build Enron as just a giant fraud. And I don't think a lot of these companies actually do that. I think they get into a situation to where they're trying to be innovative and they're taking risks because that's what their investors want them to be, and that's what they want to be. They're not unintelligent individuals. They're really smart people on how to be creative and innovative in markets, but sometimes you swing and miss.
I think these two really looked around and said, here's the rules, and I'm going to come up with my own that work inside of it. And they were desperate to get their books to look a certain way, and they read the rules and they found another way, and they decided to do it another way.
And maybe they rationalized it too because the stock was crushing it for a while. So maybe they almost lied to themselves and said, we're doing a good job, never thinking that, the check would ever come. The house of cards would ever fall, so to speak. Like, hey, we're serving our shareholders because our stock is crushing it, even though if it's crushing it because of fraud.
Yeah, and I think that's more of a personal. The stock value is more for them personally. That increases their personal wealth. That doesn't really have a bottom line effect to the financial statements of Enron.
But the shareholders, it makes them happy.
It makes them happy. I think with the rationalization that I would think for Enron was really more of that, I'll pay it back later. This arm of the business is losing money. It's okay because this one we can make money on, and all right, but that one's not making any money anymore. So how about we just make this up to where eventually one of these two is going to hit. I think they tried to trade broadband service. So they bought a bunch of bandwidth.
They partnered with Blockbuster to try to do Netflix, 20 years ago, and marketed it as a success when it was utter failure.
Right. And taking those risks create these situations where they have to borrow from themselves and finding other ways to make the books balance. Valhalla, I think, is a good example as well.
Or the California Energy.
California Energy was, that was
complicated, but
that was pretty bad.
That was predatory. It was definitely predatory.
Yeah, that was them controlling the amount of flow of energy that was flowing to California to make to push up the price of other people buying that electricity. That's a special type of fraud.
In all seriousness, do we have any takeaways for the audience, for the small business owner, his accounting, anything we're trying to teach the people?
So Sarbanes-Oxley, what it did is it changed the approach that we take as auditors when we look at the underlying books and records. And it really does add more value to the small business owner. We're going through the controls surrounding how your financial statements are produced, and we have an opportunity to talk to you about those things and help you kind of understand your financial statements in a different way. So I guess something good did come out of Enron as it relates to a better audit, a more thorough audit, and a more meaningful one, I firmly believe. And that when we finish the audit, we're not just handing you a set of financial statements that you don't understand, but a meaningful set of financial statements that you understand where they came from and what they're telling you.
Agreed. I think what Michelle said earlier about what auditing was prior to Sarbanes-Oxley was, does the thing match the thing? That's what auditing was so much beforehand. And now it's really more risk-based, more conceptual. Like, does this make sense? Do we really understand what's happening here? Applying analytics, we're applying, does the thing match the thing? Yes, but we still are looking at this in a more logical way and critical way. And at the end, it's not just a piece of paper. It's not just compliance that we've done. What is it that you're presenting? You see financial statements. What is it that this actually means for your organization, whether it's a big $100 million company or a small not-for-profit that we might do that is $100,000 worth of top-line revenue? What does this actually mean to you? And try to provide some really good analytics and critical thought on those things.
Really, it's a really helpful snapshot of what's going on.
Right. And it's not just the audit. We talked about the audit, but even just the books and records, right, and how you organize your small business of how am I going to pay my bills? How am I going to still be the owner, be the main producer, but also have someone internally that can help me do the books and pay my bills and collect the revenue, understanding some of these things and how they trickle down from the top of Sarbanes-Oxley to even the small business owner.
And how we prevent misappropriation of assets, and how we help you understand your financial statements to make sure there's not fraudulent financial reporting.
If someone's stealing a bunch of pins, we're going to find them. All right, good stuff, everyone. Thank you, Michelle. Thank you, Cohart. That's it for today's episode of the Trust Us, We're Professionals podcast, brought to you by all of us at SSC CPAs and Advisors. If you ever have any financial questions or concerns, you can always reach out to us through our website, www.ssccpas.com. Once again, that's www.ssccpas.com. You can also email the show, please do, at podcast@ssccpas.com. Cohart, Michelle, thank you for the explanation of the fraud triangle. I enjoyed it.
And for everyone who hung with us through our most accounting episode ever, thanks.
Thank you.
This podcast was recorded and is being made available by SSC Solutions, Inc., together with its affiliates and its employees, SSC, solely for informational purposes. SSC is not providing or undertaking to provide any financial, economic, legal, accounting, tax, or any other advice in or by virtue of this podcast. The information, statements, comments, views, and opinions provided in this podcast are general in nature, and such information, statements, comments, views, and opinions in the receipt of this podcast by any listener are not intended to be and should not be construed as the provision of investment advice by SSC, that listener, or generally, and do not result in any listener being considered a client or customer of SSC. The information, statements, comments, views, and opinions expressed in this podcast do not constitute and should not be construed as as an offer to buy or sell any securities or to make any investment course of action. The information, statements, comments, views, and opinions expressed or provided in this podcast, including by speakers who are not officers, employees, or agents of SSC, are not necessarily those of SSC and may not be current. SSC does not make any representation or warranty as to the accuracy or completeness of any of the information, statements, comments, views, or opinions contained in this podcast, and any liability thereof, including in respect of direct, indirect, or consequential loss or damage of any kind whatsoever, is expressly disclaimed. SSC does not undertake any obligation whatsoever to provide any form of update, amendment, change, or correction to any of this information, statements, comments, views, or opinions set forth in this podcast. No part of this podcast may, without SSC Solutions Inc.'s prior written consent, be reproduced, redistributed, published, copied, or duplicated in any form by any means.